America attacked Venezuela and is threatening Denmark. Russia's trying to occupy Ukraine. China's looking at Taiwan. When the world goes insane, it is critical to be prepared so you can keep your money and your family safe. Looking back at my 18 years in finance, including on Wall Street and here in Europe, the world has never seemed as dangerous as today. In this video, I will show you what I'm doing to protect my own investments and my family. But first, we need to understand the risks. Despite a few major disasters like COVID, the big financial crisis, and 9/11, the last few decades have been a time of global peace and stability. You could invest your money and be confident that your rights would be protected. It is natural to assume that is how it always has been and will be in the future. But if you look at history, there have been many so-called black swan events. These low-probability disasters which have wiped out unprepared investors. So let's take a look at just a few. First, you've got revolutions. The Russian Revolution in 1917, the Chinese Communist Revolution in 1949, and the Cuban Revolution in 1959 wiped out investors in those countries. The same was also true when European countries like the Baltics, where I'm from, or Poland, or Hungary, or Czechoslovakia got forced into communism during and after World War II. And later regime changes, such as the 1979 Islamic Revolution in Iran, have also been disastrous for foreign investors. Now, looking at the world today, the global wave of populism that we're seeing in the 21st century, it wouldn't be surprising if this happened again. Second, there is war. In the worst case scenario, if your country gets invaded, there is no guarantee that local money will keep its value, that local property rights will be honored, or that local banks or brokers will continue to operate. But unfortunately, war is also a major risk even if it happens far away. After Russia invaded Ukraine in 2022, a lot of foreign investments in Russia were frozen. Investors lost access to their money, and it's not clear if they will ever get it back. This is not a new phenomenon, by the way. At the outbreak of World War I, global stock exchanges closed for months. Countries including the US, Canada, France, and the UK confiscated the investments of foreigners living in enemy countries. America created this Office of Alien Property Custodian, which took over investments belonging to companies or individuals from countries such as Germany, Austro-Hungary, or the Ottoman Empire. This office quickly became the biggest trust organization in the world, holding hundreds of millions of dollars in confiscated investments. The same thing happened in World War II, and to a lesser extent during other wars. And it could happen again in the future. For example, many Europeans today are heavily invested in the American stock market. And while it's really hard to imagine that today's America could confiscate European investments, well, when the Trump administration threatens to use force against Greenland, it does make you think. Now, in a minute, I'll explain how you can protect against such risks, but first we've got a few other risks to discuss. Third, you've got sovereign defaults. This is when a country refuses to pay its debts. A lot of European investors love investing in bonds, especially government bonds, because they imagine that these are safe investments, which are virtually guaranteed not to fail. But history shows that is simply not true. For example, in 1998, Russia defaulted on its bonds, causing a global market crash. In 2001, Argentina defaulted on over $100 billion worth of bonds. And even here in the Eurozone, back in 2012, Greece defaulted on 206 billion euros in debt. This ultimately cost investors around 70% of their money. Now today, in 2026, we're seeing very high government debt levels all around the world. So we could easily see more of these default events in the coming decades. Fourth, you've got hyperinflation. This is when a currency quickly loses virtually all its value. Germany's Papiermark currency experienced hyperinflation in the early 1920s. Prices doubled every few days until the mark became worthless. People with savings in the bank, or people who held bonds denominated in these marks, were completely wiped out. At the end of World War II, Hungary's pengo experienced the highest inflation recorded in history, with prices doubling every 15 hours. More recently, Bolivia and Argentina experienced hyperinflation in the 80s, Zimbabwe in the 2000s, and Venezuela in the 2010s. When a government is in trouble, when it's deep in debt, like so many countries are today, inflating away the currency is a tempting solution. So I wouldn't be surprised if we see this again in the future. Fifth, you've got global market collapses like the financial crisis between 2007 and 2011. In addition to massive short-term losses in stock and high-yield bond markets, hundreds of banks collapsed all around the world. A lot of people lost part of their savings. And then a few years later, during a banking crisis in Cyprus, even customers of banks that didn't collapse ended up losing nearly half their uninsured deposits because the government froze bank accounts and used the money for a bailout. And we haven't even discussed other risks, such as environmental disasters or pandemics like COVID, which can also destabilize the financial system. Now, let's be clear. The probability of any one such disaster happening in any particular year is very low. But with the direction the world is going, chances are good that we will experience some such disaster in the next 5 to 10 years. So if you'd like to protect yourself, here's my first suggestion. Don't stick your head in the sand. Don't assume that business as usual will continue forever. Accept that geopolitical risks are real and prepare for them. Otherwise, you risk living in denial until it's too late. My second suggestion is especially important for those of you who live in geopolitically vulnerable countries. For example, if you see a meaningful risk of war or social unrest or revolution. To explain this suggestion, let's go back 2 centuries to the French Revolution. When this started happening, many nobles escaped France with whatever valuables they could carry on themselves. But the problem was that the vast majority of their wealth was real estate, and they could not carry that away or sell it quickly at a good price in the middle of a revolution. Their choice was to stay in France and possibly lose both their property and their heads, or to escape and start over with nothing. The same thing has happened many times in history. For example, during the Communist Revolution in Cuba, wealthy Cuban landowners and business owners had to choose between staying and losing their properties along with their freedom, or escaping but having to start over with nothing, in some cases becoming gas station attendants or taxi drivers. To avoid this happening to you, here's my second suggestion. Don't tie up all your wealth in local real estate or businesses. Make sure that at least part of your wealth is liquid. Now, there are different ways you could do this. I personally don't own any real assets. All my investments are financial, and I own an online business which I can run from anywhere. In some ways, this is great. I'm very mobile and my wealth is liquid. But my extreme approach could actually be a weakness in certain scenarios. For example, if the global financial system freezes up or if the online economy collapses, I could be in trouble. In such cases, it would be helpful to also own some real assets, such as an apartment or a local grocery store, some kind of business. Just make sure that not all your wealth is tied up in these illiquid assets. Also, don't tie up your identity with your property. Many people identify themselves with the family farm or the family shop. It can be really difficult to separate yourself from this kind of property, especially if it's been in the family for generations. But if push comes to shove, you may need to act quickly or risk losing everything. This is what happened to my grandfather's family. When the Soviet Union occupied Latvia, my family lost their farm and they got exiled to Siberia. Okay, but let's move on. Once you have some liquid money, the next question is, where do you keep it? To start with, it could be smart to have a bit of physical cash or maybe some gold coins that you can always carry with you. But for larger amounts of money, you will need a bank or brokerage. Now, obviously, holding everything with a local bank or brokerage in your own country could be risky. But it's equally risky to trust all your money to one foreign bank or broker, no matter how large or reputable it is. For example, I have an American bank account from when I used to live in the States. But looking at the current relationship between America and Europe, I wouldn't really want to hold all my money in that bank account. So over the past few years, I've opened a few different accounts in countries such as Spain, Germany, Denmark, and Ireland. Now, this does pose a practical problem. How do you open a bank account in a foreign country? It can be difficult to find traditional banks or brokers that will open accounts for foreigners. But today, there's an easy starting point. Open an account with an online bank or brokerage. For example, if you open a brokerage account with Saxo, you actually have a bank account that's based in Denmark. While if you open an account with N26 or Trade Republic, that gives you a bank account based in Germany. And these accounts are protected by German deposit guarantees. This kind of online account is easy to open, it's simple, it's straightforward, and it gives you quick geographical diversification. So my third suggestion is this: diversify your financial accounts geographically. Next up, let's discuss how to invest your money so that it's protected from geopolitical risks. But first, here is this. The next few years are likely to be a challenging time for investors here in Europe. If you're not an investment professional, it could be hard to follow all the news and figure out what is important and what you can ignore. To help you with that, I run an investment newsletter for Europeans, where I cover investing insights and comment on the most important market developments. I write it in really simple language. It's got over 100,000 readers all over Europe. And if you'd like to join them, you can just follow the link to the newsletter in the description of this video. So how should you invest your money to be protected against geopolitical problems? Well, first up, there are a few things not to do. Don't keep all your wealth just sitting in the bank. I mean, that's never a good idea. But in a geopolitical crisis, it's particularly dangerous because cash in the bank is vulnerable to bank collapses, and it's also vulnerable to hyperinflation. Now, of course, you do need a safety cushion. You need enough cash in one or a few major currencies to cover your living expenses for the next few months. Just make sure that you don't keep more than 100,000 euros in a single bank so that you can benefit from deposit protection guarantees. Oh, and also, you should prefer banks in strong, stable countries. I mean, realistically, the deposit protection guarantee in Germany is more reliable than the guarantee in Cyprus or my own country, Latvia. So this is my fourth suggestion. Only keep enough cash in the bank for your safety cushion, and the rest of the money should be invested. So where do you invest your money? Well, another bad idea would be to put all your wealth in bonds. To many Europeans, bonds seem like the safest investment out there. When you buy a government bond, you're basically lending money to the government, and they have to pay you back, right? Well, there are three problems with this. First of all, sometimes governments default. Second, bonds can fall in value dramatically when interest rates go up, which happened in 2022. And third, if inflation gets high, the value of your bond collapses. A typical bond will pay you a set schedule of euros or pounds or francs over time. So even if bread and milk and gasoline get a lot more expensive, you're still getting the same amount of money. Especially if there's hyperinflation, your bond can become completely worthless. To be clear, bonds do have a role to play in a smart long-term portfolio. As you get older, you should use bonds to reduce the risk level in your portfolio in terms of how much your portfolio swings up and down. My fifth suggestion is simply this: don't put all your wealth in bonds. This does not guarantee your safety in difficult geopolitical times. So, what alternatives are there? Well, you may know that I'm a big fan of stock investing. When you buy a stock, you buy part of a real company where people go to work every day to serve their clients and make money. Long term, in most countries around the world, stocks have outperformed inflation by a lot. They have even been quite resilient in times of extremely high inflation because when prices shoot up, company revenues also go up. Now, of course, if the country where you're investing has a communist revolution, then your stocks will become worthless. But on the whole, stocks have been a pretty robust investment historically. Now, the challenge is that there are thousands of stocks out there, and choosing the best ones is a difficult job. It requires a lot of expertise and effort. That's why I invest in stocks using ETFs and index funds. With an ETF or index fund, you invest in hundreds of different stocks in different countries and industries around the world. As Nobel Prize winner Harry Markowitz said, the only free lunch in investing is diversification. Now, he was talking about financial diversification, but obviously this also protects you from geopolitical risks. If any one country has that communist revolution, well, you will only lose a fraction of your assets, not everything. The classic passive investing approach to geographical diversification is called market cap investing. This is when your money gets invested automatically all over the world in proportion to how big each respective stock market is. Market cap investing is very easy to do. You can buy a simple global ETF like the Vanguard FTSE All World UCITS ETF or the iShares MSCI ACWI UCITS ETF. And with this kind of ETF, your money will get invested in thousands of different companies in many global countries. But there is one obvious problem with this approach if you are worried about geopolitical risk. With an all-world stock ETF today, around 60% of your money will be invested in just one country. the biggest stock market in the world, which of course is America. Now, to be clear, the American stock market has been the best performer over the past century, and it may well continue to be a great performer going forward. And sure, the American stock market is quite diverse on its own. There are many different industries and companies represented. But in a different sense, it's not diverse at all, because every single American stock is directly exposed to the decisions of one very stable genius in the White House. So the question is, are you happy to have over 60% of your money in American stocks? And if not, what can you do about it? Before you do anything, consider the location of all your financial assets, not just your stocks and ETFs. Sometimes people worry about investing too much in America, but then it turns out that ETFs are only 10 or 20% of their net worth, and most of their wealth is tied up in Spanish real estate or an Italian private business. In that case, your all-world ETF is probably fine, because only a small fraction of your total wealth is exposed to America. I myself have substantial business interests here in Europe, and that's why I'm fine having my ETF portfolio invested in an all-world stock ETF. But if ETFs represent all the money that you have in the world, then having a 60% exposure to America might seem quite risky. So if that's the case, you can reduce that exposure. For example, by adding a home bias to your portfolio. This is where you invest maybe 20 to 40% of your money closer to home, where your investor rights are better protected. If you live in a major market like the UK, Germany, or France, this could mean putting 20 to 40% into your own country's stock market. Or you could invest in multiple European countries using an ETF like the iShares Core MSCI Europe UCITS ETF. That said, there are many ways to build a diversified global portfolio, and I've covered this topic in a lot more detail in other videos. My suggestion number 6 is simply this. Make sure that your portfolio is not overexposed to any single country. And then there is one technical suggestion for ETF investors. Prefer ETFs domiciled or legally established in a European country. If you live in the EU, or in the UK, you already have no choice. Because of regulations, you can only buy local ETFs, usually based in Ireland or Luxembourg. But if you live in other European countries like Switzerland or Georgia or Ukraine, you also have access to ETFs based in America. Now, as long as you're investing in American stocks, that doesn't really matter because you're exposed to America anyway. But if you're buying an ETF that invests outside America, I would prefer ETFs that are legally based in Europe, to reduce the risk that American politics interferes with your investments. All this said, I want to be really clear about something. Chances are you will not need most of these precautions. While it is possible that we will experience war or violent revolutions here in Europe in the coming years, I don't think it's the most likely outcome. Yes, take these precautions so that you are ready, but in the meantime, don't let fear paralyze you. That's not going to help you or your family. Today, I sincerely believe that all Europeans should be saving and investing and building financial freedom, because no matter what the future brings, it will be easier if you have some investments. Unfortunately, if you live in Europe, it can be a bit difficult to start investing sometimes. It can feel overwhelming because you have 100 different questions. Which broker or investment app should you trust with your money? What strategy makes sense for your age, your goals, and your tax situation? When is the right moment to start? Should you invest all your savings at once or spread them out over time? And how do you handle taxes? On this YouTube channel, I help you figure all this out one video at a time. But if you'd like a faster, step-by-step solution that takes you from A to Z and also includes one-on-one support from me, you might be interested in my training program for European investors, the Index Masterclass. Today, the program has thousands of members in 34 European countries. And in my opinion, it's one of the easiest ways to get started with ETF investing if you live in Europe. So if you want to find out more, just follow the link in the description.